What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is November 27th of 2018. Well, folks, I hope you all are having a wonderful day wherever you are. Today, it's time for a daily update here on the Data Dash channel. We've got a ton of different things to cover here on the update. I do want to apologize first and foremost that I know I've been quite absent over the past few days. I've been really busy here in Estonia at the MoonTech conference, and I know it's probably not the best time to be absent, so I apologize for that, guys. However, we've got a lot of important things to discuss, and I really want to spend some time to do a little bit of catch up and talk about what's going on in the crypto market at the moment, and also how I'm taking it all in, what I'm focusing on, and really what my strategy is, and the advice that I can give. Not so much financial advice, but really just kind of an advice of perspective, and trying to, again, kind of comprehend what's going on and not to get too caught up in emotions, but focus on strategy. All right. So we've got lots of things. We'll also talk a little bit about traditional markets, predominantly in the housing sector, and some interesting parts in that. So let's go ahead. Let's focus in on the main topic here, cryptocurrencies. So obviously, guys, over the past 2 weeks, we've seen a lot of bloodshed in crypto, and over the past few days, we've had some, really an up day and a down day. So we've been pretty much pushing sideways now. Seems like most of the sell side has definitely mitigated. However, we are obviously still seeing more players in the red over the past 24 hours. Along with that as well, just want to let you guys know, not trying to push it too much, but if you guys haven't heard already, I know not everyone gets to watch every daily update. I've got the Dash report coming out. This is the newsletter that covers crypto, equities, Forex markets, as well as commodities. If you guys are interested in that, it's linked down below in the description. But going on, I want to spend some time to really kind of rush through this kind of basic stuff. Obviously, we know that market valuations have been depleting over the past few days and have reached really not that much lower of levels. Again, we haven't been seeing the rapid sell side action of last week. As we can take it here to the 30-day, we saw a much more rapid decline over the past previous week than this week. So it's nice to see that some of that sell side is starting to slow down. It looks like we might be getting towards an area where we can start to form a bottom in this market. I'm not saying we're there yet, but at least the sell side momentum is slowing. You can start to pick up on the momentum and see when the market is starting to build more confidence and resilience. And as we can see, volatility is still relatively high at the moment. But interesting enough that even during this crazy sell-off, that we're not seeing Bitcoin dominance skyrocketing. This is really fascinating to me. This is something that usually does not happen when we see a correction. We tend to find Bitcoin dominance spiking upward and altcoins just falling off the face of the earth. Now, they obviously felt some pain, but we haven't been seeing that here in regards to the transition on Bitcoin dominance. So very fascinating here. Other coins have actually been gaining dominance during this time period. Ripple and other I would say, again, not being downplaying on XRP or anything, but these are usually the very high run-ups during high-risk periods, which is really interesting to see that these are doing well. And that goes with other players like Dogecoin and Stellar Lumens and a variety of other players as well. So that's very fascinating. But again, there's not much to extract from that, I think, at the moment that I can at least provide you guys. So I want to spend some time. We can obviously see here on the daily things have been quite brutal. I do like seeing here that we've got rising lows here on Bitcoin over the past 2 days. But I want to go ahead and kind of spend some time, guys. We don't need to do too much crazy TA. I can provide you some chart on Bitcoin right now, and it might be completely irrelevant in the next few hours because Bitcoin could continue down to 3,000, or it could continue upwards towards the mid 4,000 range. Who knows? I want to spend some time to really talk about the macro scale of things, and also to talk a little bit about some lessons that I took away from this massive market cycle. We were right a lot of the time as a community, whether it be people on the bullish side of things or the bearish side of things. People usually make a lot of good calls, and they sometimes make some very bad calls. And I definitely say that this year has taught me that I was right on a few things and I was wrong on a few things. Again, I'm always very open to that, guys. I really don't feel any shame in making mistakes because I learn a lot from my mistakes, and you're never going to progress unless you make mistakes in markets. Or at least you're not going to be prepared for the future and future opportunities. But I want to spend some genuine time to share with you all the thoughts I had the other day in a few moments through a tweet that I put out in regards to what I had learned from this previous market cycle. So we'll dive through that in just a second. But I want to talk about one thing before we go on to that, which is kind of the difference in shorts and longs in the market. Shorts have gained a lot of confidence over the past few days and have gotten back into the range again of the upper 30,000 contract range on Bitfinex. Not to mention they have held dominance here on BitMEX in this case. We can see shorts are holding a decent 10% hold against those in the long market. So in this case, we can see shorts are holding confidence here. Again, setting up for a potential short squeeze in this case if things start to really move here. The order book is very thin. That's the only thing I'm going to say, guys, that even though this downside action has actually had some decent volume, I'm not going to lie on that. In a low volume market like this, if people start offloading, people don't realize that we're not actually getting more serious trading. It's not showing up here. I guess it's because it's Coinbase. I'll go ahead and look at something like Bitstamp. You can see just how thin the order book is all the way up to prices like 6,000. I'll go ahead and zoom in a little bit. You can see the longs here at these levels are so much more comparative to the sell side on the asks. So if a buyer comes in, a pretty large buyer buying 5 or 10,000 Bitcoin per exchange, you're going to start to clear through this order book and see price take some massive moves. And that's what we've been seeing over the past few hours. So go ahead here. You can see some of these big rebounds where not even close to the kind of sellers we were getting come in, and you see these big moves in price. It's because the longs, or the bids in this case, on the order book are far outweighing the sell side in regards to the ask. So very important to take that into mind. But anyways, I saw a really good tweet here, and I think these things are kind of important reminders. This is Nye, the crypto guy. I met him back actually in Bangkok when I went to the Hybrid Block Summit. Really nice guy. He's just a very personable guy to be with and everything. And I think he put out a really good tweet. I think actually I got it right when he put it out, basically saying that there are many people back a few months ago talking about the euphoric phase, that things will never stop going up. And I'm going to recall this because I very much remember this. And I also know that there's also those same people as well. And this is with every market, guys. And if you find yourself in these shoes, I'm not trying to insult you. I just want to spend some time to at least provide some perspective. I'm always going to be honest with you and try to get my point across. But he mentioned that there's a lot of people during the euphoric stage that say things will never stop, that December was going to keep going on through 2018. I remember the excitement that people had, and I was quite excited too about crypto. At least it set a precedent that this was going to be a space that was going to last for a very long time. And along with that, there's those same people who say that it's never going to stop going down when we hit the bear market. People get caught up in their emotions, and it's understandable, guys. There's a lot of sad stories that come when markets don't go right? And there's a lot of people who've lost, and I understand that. It can be very hard. I know I've gotten hit quite bad, guys, from this downside. So I want to spend some time to emphasize a few things here. I took a lot of lessons from this market correction. I can say I got one thing right, and that was back in December and January, I could feel that the euphoria was peaking out. And about 2 days before the actual peak in altcoins, I actually got out of my altcoin positions. I had a few long-term positions I stayed in, as I shared on the channel. As you all know, I always let you all know what I'm doing. I got out of most of my altcoin positions at kind of peak euphoria, so I timed the top quite well, but I was still well exposed into Bitcoin. And because of that, I've felt a lot of the pain, not to mention I've dabbled a little bit with altcoins as we've gone towards the 6,000 to 7,000 range in crypto. But putting all of that aside, I want to spend some time to talk about where I got things wrong, okay? Now, I hope that you guys never follow my advice directly. I hope you just take it as one single perspective, but I'm very open to learning about where I miss on things. And there was really 3 things that I noticed that I think we have to learn from, and I hope that you guys will take away as a positive learning experience. The first one is that, after the kind of rally we saw last year, the 20x in Bitcoin from the lower range of about 1,000 in 2017 all the way up to the close of 2017 at 20,000 or near 20,000. We saw generally about a 20x that we should have expected an inevitable 80% plus correction in Bitcoin. And not to mention, we have to consider the fact that there were so many ICOs and altcoins that did even better and carried valuations much more than a 20x in crypto markets. And the reason I say this is because that history tends to repeat itself. When Bitcoin has these parabolic rises, we usually tend to see an 80% plus correction. And I think many of us got confident on the idea that, it doesn't matter, we've got Bakkt coming around the corner and all these catalysts, as I'll get to in a minute. And because of that, a 66 to 70% correction is a-okay. We can put it off and we can get confident that this is the worst that we're going to see. And we did hold 6K for a while, so it was very easy to get caught in that, that kind of mindset. But I think it's something important to take away as a lesson that history tends to show us that in crypto markets, we see an 80 to 90% correction from the peak highs. So it's something to take away, and it can actually prove a lot of great opportunity for those who do like to trade those cycles, where you can get massive discounts if you're just patient and you wait, and you can keep on increasing your position in cryptocurrencies. The second thing, though, I want to talk about is something that I think more than any of these three, I was extremely guilty of. And it's something that I can sometimes get caught in. I think we all kind of get caught in because we get caught in the bubble of crypto sometimes, much like those who get caught in the bubble of tech stocks in the equities market, or get caught up in the bubble of gold and silver in the commodities market. And that is that catalysts can take much longer to come to fruition. So I know for the past year, again, as guilty as charged, many of us talked about BACT and an ETF right around the corner. And what was kind of hard was me coming to the realization over time as the first few, not so much rejections, but really the kind of postponings came in from the SEC on the Bitcoin ETF. I started to meet a lot of people as I traveled, and I met some great people who have worked in the traditional institutional space. And it started to show me slowly, time over time, that these things take a long time to get through. And it definitely kind of got me out of my bubble, and I started to realize that. And I've shared that over time that these things do take time, and that these rejections could mean we could see it later on. However, at the same time, I was calling earlier on in the year for this to happen in 2018. It's sad that I had made that call earlier and learned about these things later on, which is why I did change my position, and I kind of mentioned that about a month or two ago. So again, one of those things that we have to learn from, that catalysts can take time, especially when you have these drawn out bear markets. It's important to think that when you see something coming in the headlines, that you should always take it as a grain of salt, okay? And that even goes for here on this channel, guys. Again, I'm not trying to sell you guys in hype. I'm not like the news articles. That's why I don't post videos every single day on the most monotonous things. But I'm going to try to find the most genuine things for you guys. But at the same time, I can make wrong calls, okay? So it's a very important thing to take away. And three is just how vulnerable price is to low liquidity. This is something I think we all underestimated. Anyone on the bull side really underestimated. And even I think shorts didn't really take into mind is just how vulnerable price is to low liquidity. And this is something that I want to spend some time ranting on. I think a lot of this downside action, guys, as we'll talk about at a recent interview I did with Dr. Prash, who he works at Caliber Brown and works in OTC markets. That's one of the new podcasts coming up here in the next few days. We talked about how in a low liquidity market, people who are in the OTC business, as well as those in the the leveraged exchanges such as BitMEX, who are trading on margin, they have a massive incentive to manipulate the spot market and make more money on leveraged exchanges, or to pick up large positions in OTC and spend some money dragging down the spot market. There's a huge set of incentives to act bad in that sense, if you consider that a bad, acting as a bad actor in order to make extra profit. And it's quite self-explanatory. We'll talk a little bit about that more in the video with Dr. Prash, but these are the general three lessons I can put across, guys, to learn from. And again, to come at markets with more of a rational perspective. This has been a great learning lesson for us, guys, a really great learning lesson. And that's why I don't get really upset about it. You don't see me, panicking, getting all emotional, because I have a responsibility, and in that responsibility, I'm going to act as mature as possible and help you guys. And I know that the best thing I can do is to teach you guys, to the best of my ability, how I react to markets and how I've learned over the years. It's been one of the greatest learning experiences I've had outside of my previous learning experiences in equity markets. And by learning experiences, I'm talking about moments of failure. Everyone has them. But I can tell you, I've been successful in the longer term things. I've been able to make money and continue sorry, my throat's a little dry, guys. I haven't been drinking enough water. In regards to learning over time in crypto markets. So yeah, but anyways, enough rambling on that. So going on, I want to spend some time to talk about traditional markets. I saw some interesting headlines here, and this kind of goes towards talking about, again, how I'm focusing still on cryptos and commodities going into 2019, and the inevitable kind of cracks that we're starting to see in the equities and asset market in general. And I want to focus in a little bit on the housing market here. And we've talked a lot about what's propped up the housing market across the world, whether you're looking at Europe, or you're looking at Canada or Australia or the United States. Really, in the developed world, we have seen a massive real estate bubble. If you go from cities like London, if you go to cities like Vancouver, if you go to cities like Boston or New York City or Los Angeles or San Francisco, doesn't matter where you are, massive real estate bubble across the board. Well, this is something that I felt would be very important to point out. As we've talked about the outflow of money from China investing in US properties, the issue is even worse than we thought. There has been a recent headline for a recent study that came out of basically a crime research network inside, I think was it inside of Vancouver? Basically, the report came out stating that over the past few years, in 2016 alone, there was $1 billion of money laundered into Vancouver from China, but in overall, about $5 billion from crime networks laundering into real estate properties since 2012. And this is a serious, amount of money that's flowing into Canada, Canadian properties from these crime networks, basically from fentanyl, which is basically a form of opiates, and has played into the crisis, and not only Canada but also abroad in the world, of the crime networks of opiates being transmitted over across borders. And man, it has been something that I've had personal friends and family have been affected by this, but it's become an even bigger issue because these people don't want to send the money back, to China in this case. They want to launder the money. They want to actually put it back into the circulation of the economy and have it untraced, have no one know that this is criminal money, and be able to have it back into the economy. That's obviously what happens when you launder money. Well, in this case, they've been able to put it into Canadian properties, and this has played a huge role outside of the money that's already been flowing in from China and other countries where money's been escaping from areas where people believe that they don't trust their government. And $5 billion worth of buy-side activity has really helped to prop up these properties to areas where average citizens can't afford the properties in Vancouver. I saw it when I went to Toronto. I know Vancouver's even worse about it. But just think, if this is just Vancouver, what does it mean for Toronto? And what does it mean for the other cities in Canada? What does it mean for other areas of the world that we might not know this is happening in? So it's very, very important to factor this in and to understand that there's been a lot that we probably don't know that's been going on under the table. And this is, again, coming at a time where in 2017, we don't even know what the numbers are for 2018, where basically we saw investments from China into foreign properties in the United States drop more than half in a single year. So this is really concerning alone, not to mention the things we don't know about, for example, what's going on with the fentanyl crisis and money laundering into the United States, in Canada, and more developed economies. So when we have these things starting to reverse, it's not just simply about interest rates, guys. We have so many other macro factors that are playing into account that are going to start having a weight on not only assets in general, but specifically on the housing market, which has been propped up beyond belief over the past few years. It seems like we've gotten right back into the bubble we had back in 2006. But this is something that isn't as obvious, and at the same time has happened at a slightly slower pace, I'd say. There's not the kind of euphoria. You don't have the crazy amount of retail consumers taking out mortgages. It's mostly investment properties, and it's definitely, I would say, very much like how it is in Silicon Valley with investing in startups. It's a Ponzi in a sense. You think you can just keep pressing it and going on, and eventually the dominoes start to fall, and it's starting to drop in a pretty dramatic way if you look at some of the major cities across, for example, Europe, like London. If you look at Sydney in Australia, and also in the United States and Canada, it's getting quite brutal. This is the last chart I'm going to leave you guys with today, outside of looking at equities, and that is the Fed effect. Now, this was a really, really cool chart I saw that basically not only takes into account the periods of time when the Fed stops bottoming rates or lowering rates and actually starts to rise rates, and to see how quick markets start to turn back over and we start to see a recession. And interestingly enough, this chart actually adds another factor, which is the implied tightening of quantitative easing and the unwind of the Federal Reserve's balance sheet from all of the treasuries, the mortgage-backed securities that it took on, and now that it starts to inject those assets back onto the market and starts to take that capital back in. If you factor that in with the rise in interest rates, we have actually reached a level we had not seen back since the 80s. We've actually gone beyond that. And if we continue to rise going into this year, this would pretty much bring levels up to 6 or 7% if we get the rises that we're talking about. So that alone is going to be very, very concerning with 3 potential rises going into 2019. I don't think you're going to see that. But if the Fed does actually stick to its guns, that's going to be very, very negative for the U.S. economy, predominantly in assets. And you're going to see a massive, massive turnover in equity prices in the stock market. You're going to see people not being able to afford mortgages. You're going to see the real estate market plummet like a rock. That's going to be very concerning. And not to mention, the Fed's going to keep on unwinding its balance sheet. What happens when both of those continue to play into effect? So going on here, we'll take a quick look here at equity markets. Take a look at the Qs here. The Qs had a nice little rebound the other day, but again, playing into this descending channel. The key here, guys, to take into account is that if you see, you might see a rally here over the next few days. I would have no doubt as we continue to play into this channel with lowering lows and lowering highs. If you get a third lower rejection here on the highs here on the Qs, even after a nice rally, things are going to get very, very nasty very quick, okay? So a very important thing to watch. S&P 500, again, same thing here, generally around this area of topping and price. I don't even think you're going to be able to get back up here on the S&P 500 before we get a more steady correction. I think we need a 2015 styled set of fear really picking up, and we need a catalyst. I don't know what that's going to be, but I think you're going to have a headline here in the next few weeks that really starts to drag down markets, and the algos are going to start trading quite negatively. Going on, I want to spend some time to talk a little bit about the housing sector. We've been talking about this obviously not only in this video, but for quite some time. I think you're going to get a rejection up here around 19 on the home builders index, and when that happens, you're going to get a roll back down and get a chance to break down below 17. And from there on, I'll be talking again about in the newsletter a little bit how I'm going to be playing it, but I think you're going to get it back down to this range of 12 to 14 on the index, or 12 to 14 points, which is still a very nice start correction. So not getting bullish on the home builders because I think you're going to break the 50 and 200 month here, which is going to be very brutal in regards to a technical side of things. But the big thing here is the FANG stocks. So FANG stocks have been dwindling here. I think you're going to break down below the 2018 levels here, and when you get that, it is going to be an obvious bloodshed, as it already has been for the FANG stocks. So again, we'll talk a little bit more over time about that. There's not too much of a trend shift, guys. I know many of you don't trade too much in equities. My general point is equities right now and assets in general are on the downward side of things, right? They're going to be continuing on their downtrend. This is not simply a mere 10% correction. We're starting to see in tech stocks, for example, like Amazon, they're starting to look like they're playing through the dot-com bubble again. They're going through the serious run-up and they're going through the serious correction. We've already seen Facebook dwindling down to its 50-month. And if this breaks, all hell will break loose. Same goes with companies like Apple, which are doing $100 billion of stock buybacks over the next 2 years, yet it can't keep up its asset price. How is that possible? It shows that there's a wash of sellers and there's not enough buyers at the moment. So again, important lessons to take in mind. We're going from a risk on to a risk off market at the moment on global equities. And the US, surprisingly, is holding stronger than any other nation, yet we're seeing this. So it's an important note to take into account. Anyways, I've rambled on enough today, guys. Hope you guys are doing well. Again, want to go back real quick just to stay on the crypto markets, guys. I'm still long on crypto. I'm still going to be here. I'm always going to be here with you guys because I love this space. I love not only the investment side of cryptocurrencies, but I really do. I know the ironic saying, oh, I'm in it for the tech. I really do love this technology, guys. That's why I'm working on Project Genesis and a lot of great things that I hope will help bring expansion and adoption to the space. But these things take time, guys. These are market cycles. And if we're going to stick it in the long term, we got to understand that there are the ups and downs, and we got to learn how to play strategic in whatever way we decide to trade or invest. All right. So that's it for the video. Thank you all so much for watching wherever you are in the world. I hope you have a fantastic day, and I'll see you all in the next video. Stay tuned.